Good morning, everyone. I get to say that for the next 5 minutes. I'm pretty impressed that all of you realized that this was at 11:55 and not at noon. I realized that at 11:30, so I almost started my session late. Welcome. We're here to talk about public service loan forgiveness and the very expertly named Temporary Expanded Public Service Loan Forgiveness Programs. As all of you know, virtually nobody is qualified for either of these programs yet. I imagine that's why most of you are here. We're going to talk about why that's the case and a variety of things that we are doing to try to improve the customer experience related to both of these programs. So with that, let's get started. The basics for public service loan forgiveness seem very simple on their face. You need to make 120 qualifying payments on direct loans in a qualifying repayment plan while working for a qualifying employer. And you need to work for a qualifying employer both when you apply for and receive PSLF. So again, that seems very simple on its face. It's not quite actually so simple. First, let's talk about which loans qualify. On the prior slide, I talked about direct loans. Those are the only loans that in fact do qualify for PSLF or TEPSLF. However, borrowers who have Perkins loans or loans made under the Federal Family Education Loan Program can begin to qualify if a borrower consolidates them into a direct loan. However, only payments made on that new direct loan qualify towards PSLF. So if you have a borrower who was in the FEL program and was making payments for maybe 10 years and they suddenly learn that they need to consolidate in order to receive PSLF, none of those 10 years of payments are going to count towards PSLF or TEPSLF. And basically both PSLF and TEPSLF work in the same fundamental way, except for some special requirements for TEPSLF. So I'm going to talk about both programs in the same breath because they are fundamentally the same, except where they're different. Qualifying employment. The biggest thing that people don't understand about PSLF on the employment side is that it doesn't matter what you do, it matters where you work. So if you think about teacher loan forgiveness, right, you need to be a teacher. For public service loan forgiveness, you can be a teacher at your school, you can be a financial aid administrator at your school, you can be a librarian at your school. It doesn't matter. If your employer qualifies, your employment qualifies. And the criteria for whether or not an employer qualifies or not are as follows. If you're a government employer at any level, federal, state, local, tribal governments, you are a qualifying employer. If you are a 501c3 not-for-profit organization, you qualify. And if you are a not-for-profit organization that is not a 501c3 organization, and you provide a specific qualifying service, and we have a list of qualifying services on our website, you are also a qualifying employer. If you have 5 seconds to tell someone what a qualifying employer is in an elevator, only talk about the first two categories, government and 501c3s. It's very rare that we have found any not-for-profit organization that is not a 501c3 that actually qualifies. It can happen, and it does happen, but it's actually quite rare. To have qualifying employment, you also need to work full-time. And there are a lot of different understandings about what full-time is. But for our purposes, full-time is the greater of whatever your employer says it is, or 30 hours per week. And so basically, because nobody works for an employer that's going to define full-time as less than 30 hours a week, personally I wish the Department of Education would, but they don't. It's whatever your employer is. So 40 hours is the standard full-time work week in the US. It is for me, it probably is for you. We all probably actually work a lot more than 40 hours a week, but 40 hours a week, if that's what your employer says, is the standard that you're held to. If you work from multiple part-time jobs, which is increasingly common in the US, you can aggregate those multiple part-time jobs together in order to qualify as a full-time employee. And when that is the case, we hold you to a 30-hour per week full-time standard for the purposes of PSLF. And of course, because we're the government and we love exceptions, If you work for a not-for-profit organization and happen to engage in religious instruction, worship services, or any form of proselytizing, those hours have to be factored out of your employment when determining whether or not you're a full-time employee or not. And that's something that we very much defer to the employer on. Qualifying repayment plans. The first thing on this list is the 10-year standard repayment plan. Never tell a borrower that that is a qualifying repayment plan. It is, but never tell them this, and I'll explain why in a minute. The other repayment plans that you see on the slide are IBR, ICR, pay-as-you-earn, and repay. Those are our income-driven repayment plans. If a borrower makes payments under the 10-year standard repayment plan before switching into an income-driven repayment plan, that is fine. They actually still have a shot at receiving public service loan forgiveness. But the 10-year standard repayment plan is a repayment plan that ensures your loan is fully repaid after 10 years of payments. Public service loan forgiveness requires 10 years of payments. So if you spend 10 years in the 10-year standard repayment plan, you can qualify for PSLF in the amount of $0 because your loan will be fully repaid. This is not a rule that we made. Congress created this rule. I do not know why they created this rule. However, what I will say, because I try to rationalize everything, is that the 10-year standard repayment plan is the default repayment plan. When your loans go into repayment, if you don't make another election, the 10-year standard repayment plan is what you get. So I like to think about the 10-year standard repayment plan as a qualifying plan for PSLF as a grandfathering mechanism. If you didn't know what you needed to do to get PSLF, which again is change into an income-driven repayment plan, once you finally figure that out, you're not starting over from scratch. The payments that you may have been able to afford and make under the 10-year standard plan continue to qualify. Qualifying payments. We're talking about 120 separate monthly payments. You can't write us a check for 10 years of payments and ask for PSLF right away. We're talking about a steady stream of payments month over month for 10 years, maybe longer, but at least 10 years in order to receive PSLF. They need to be made after October 1, 2007, which is when the law that created PSLF passed. So that's why no one could potentially qualify for PSLF until 2017. We're obviously finally after 2017, so borrowers can and do qualify for PSLF now. The payments don't need to be consecutive, however. So if you go in or out of qualifying employment, if you go in or out of a deferment or forbearance, that does not reset your clock. A lot of programs require consecutive behavior. Public service loan forgiveness is not one of them. So if you go into deferment for a year after having made a year of qualifying payments, when you come out of deferment, you pick right back up where you left off, starting with year 2 of qualifying payments. Of course, they have to be for the full amount due under your repayment plan. So if you're due $100 a month and you pay us $50, that does not count. You're also delinquent, which is not great. And they need to be made on time, which is to say within 15 days of the due date. So these are very logical things. You get a bill, it has an amount, you pay that amount, and you pay it on time, and it should qualify. The best way, again, if you're counseling students about how to get PSLF, is to get into an income-driven repayment plan and go on automatic debit, because then every month on their due date, their payment comes out of their bank account. And of course, they also get a 25 basis point reduction in their interest rate, which is helpful. The payment amount that borrowers make, of course, when I'm talking about automatic debit, right, like your payment comes out of your checking account on your due date for the full amount, but some borrowers don't want to do that, and that's fine. Some borrowers like to break their monthly payment up. Maybe every time they get paid, if they're paid every 2 weeks, they want to pay half now and half later. That's fine. So long as we receive the full amount due before 15 days after the due date, generally speaking, though that will count as 1 month. Payments made when not required, however, don't qualify. So if you have a borrower who is maybe making payments while in school, or is in a deferment or forbearance and making payments, maybe just interest payments, those don't count. You need to have a legal obligation to make a payment in order to actually receive credit for a month towards PSLF. We have some special rules about lump sum payments that apply to very few people, and so I'm not going to talk about them. However, you should be aware if you're ever counseling someone who is going to do AmeriCorps, Peace Corps, or who is going to enter some type of employment that is tied to the Department of Defense, know that there are some special rules for them, and you can find out more about those rules on our website. So now that we've talked about the basics of public service loan forgiveness, we're going to sort of model out how public service loan forgiveness can work in practice if a borrower does absolutely everything right from the beginning, because we know borrowers always do that. I like alliteration, so I have named our example borrower Billy Borrower. I'm also very creative with the names. Billy is single, has no dependents, and lives in Georgia. And he lives in Georgia because last year we were in Georgia and I did not update this slide to say that he lives in Nevada. He has an adjusted gross income of $35,000 a year that rises at the perhaps unreasonable rate of 5% per year. I do not get a 5% raise every year. I really wish that were true. The reason why I've made this assumption is that our current repayment calculator on our website makes this unreasonable assumption as well. If you haven't gone to any of the next-gen sessions yet, and there may still be some, I'm not sure, we are releasing a new calculator called the Loan Simulator in the near future. It no longer will make this unreasonable assumption and will allow users to specify an actual amount that they want to put in for this assumption. But ultimately, we need to make assumptions if we're doing these types of projections about public service loan forgiveness, because you need to be on an income-driven repayment plan. Those plans require that you recertify your income every year. Most people's income does ultimately increase over time, and so we have to make some assumptions. And we'll say that Billy Borrower has $50,000 of direct loan debt, $23,000 of which is subsidized, and because I really like it when the math is easy, all of his loans have a 6% interest rate. Billy also borrowed for graduate school, and since I'm not presenting about income-driven repayment this year, I'll tell you a little bit more about why that matters. For the income-driven repayment plan called Repay, Revised Pay-As-You-Earn, borrowers can receive forgiveness under that plan, and all income-driven repayment plans, but specific to Revised Pay-As-You-Earn, there's a different forgiveness clock between 20 and 25. It's 20 or 25 years. And whether or not it's 20 or 25 for any given individual depends on whether or not that individual borrowed for graduate school. If that individual did borrow for graduate school, then the forgiveness clock is 25 years. If they did not borrow for graduate school, i.e. they only borrowed for undergraduate school, then the forgiveness clock is 20 years. So for Billy Borrower, if he's in repay, he would be subject to a 25-year forgiveness period because he went to graduate school. Here's how public service loan forgiveness shakes out for Billy. On the slide at the top, what you see is what Billy would pay for how long and how much he would get forgiven under public service loan forgiveness. If Billy was not pursuing PSLF, or perhaps more importantly, thought he was and then doesn't qualify, then this is what would happen if he does not get PSLF. And excuse me, I got that backwards. The top of the slide is what happens if he doesn't qualify for PSLF, and the bottom is what happens when he does. Of course, on this slide, I'm only presenting the income-driven repayment plans, so hearkening back to our discussion earlier, you can also imagine a 10-year standard repayment bucket being here. He would receive zero forgiveness under either situation because his loans would be repaid in full. But under ICR without PSLF, he would get nothing forgiven. With IBR without PSLF, he would get nothing forgiven because he would pay his loans in full before the end of 20 or 25 years for those plans. Under Pay-As-You-Earn and Revised Pay-As-You-Earn, without public service loan forgiveness, he would actually get some debt forgiven, depending on which plan. And obviously, the difference between Pay-As-You-Earn and Revised Pay-As-You-Earn without public service loan forgiveness is a pretty big difference in how much he's going to get forgiven, right? It's about $42,000 of difference. And bear in mind, Billy also only borrowed $50,000 of debt. So under Pay-As-You-Earn, he's getting almost the entire initial amount that he borrowed forgiven. And this is just a fundamental way that income-driven repayment plans work, and the way that loans work. Income-driven repayment plans can actually allow for what's called negative amortization, where your payment amount being solely based on your income and family size, and not traditional factors like how much you've borrowed or your interest rate, can actually mean that your payment amount is less than the amount of interest that is accruing on your loans every month. And if you're trying to actually pay your debt back, negative amortization is very bad. But if you are in an income-driven repayment plan because you can't afford any other payment, then negative amortization is a good thing because you can theoretically afford to pay whatever your payment amount is under an income-driven repayment plan. And so under pay-as-you-earn, that is in fact why Billy is getting his entire debt amount, initial debt amount forgiven. You can see on this slide as well that in order to get that in total of almost $50,000 forgiven under pay-as-you-earn, Billy has to pay almost $86,000 over the course of 20 years, which is a very long time and a lot of money, in order to get that amount forgiven. So Billy is definitely not getting forgiveness for free. He's paying a lot of money in order to do so. But this is just income-driven repayment when it's not coupled with public service loan forgiveness. When you couple income-driven repayment with public service loan forgiveness, things look very different. First of all, under ICR and IBR, where Billy would not have received loan forgiveness at all without PSLF, he does, in varying amounts of between $27,000 and $55,000 approximately. Looking at pay-as-you-earn and revised pay-as-you-earn, Billy's getting significantly more money forgiven. And again, the reason why this is true, and if we were presenting on income-driven repayment this year, I would just tell you to come to that session, but we're not. So all of these income-driven repayment plans calculate payments differently, somewhere between 10 to 20% of your income, generally speaking. And so the amount that you get forgiven under public service loan forgiveness is of course a function of your income and is of course a function of your family size, but it's also a function of what percentage of your income we are calculating your payment based on. So anytime you see higher amounts forgiven, that's because payments are a smaller percentage of discretionary income. But basically, there is this fundamental relationship between public service loan forgiveness and income-driven repayment. Until temporary expanded public service loan forgiveness became a thing, I would say you cannot get loan forgiveness unless you get into an income-driven repayment plan. And that is true for public service loan forgiveness. We'll talk in a minute about temporary expanded public service loan forgiveness, or TEPSLF, and why that is no longer necessarily the case. But if you are advising a borrower on what to do, you want them to pursue public service loan forgiveness. And so you need to advise them in order to get into an income-driven repayment plan in order to receive it. So all of this seems pretty complicated, and we've done a variety of things over the course of the last 10 or so years in order to try to ensure that borrowers can figure out whether or not they're doing everything right for the purposes of public service loan forgiveness. If you have, again, 5 seconds in an elevator and are talking to someone who wants to receive public service loan forgiveness, the one thing that you should tell them to do is fill out what we call the PSLF employment certification form. What this form does is provides borrowers an early look of whether or not they're actually doing everything right for public service loan forgiveness. It checks whether or not they have a direct loan. It checks whether or not their employer qualifies. And it also checks for how many payments they have made that qualify for PSLF during their period of qualifying employment. The way that the process works generally is that a borrower is going to submit this form to Fed Loan Servicing. They are our exclusive public service loan forgiveness servicer. They are the only ones only ones of our contractors who will provide information about whether or not an employer or any given payment qualifies for public service loan forgiveness. So borrowers submit this form to them. Fed Loan Servicing first determines whether or not the borrower has direct loans, and if not, sends the borrower a letter saying you can't qualify for PSLF. If you want to, you must consolidate your loans. Fed Loan Servicing will then determine if the employment qualifies for public service loan forgiveness. And if not, of course, the borrower is going to get a letter saying your employment does not qualify for public service loan forgiveness. But if the employment does qualify, Fed Loan Servicing will then have all of the borrower's loans that we own transferred to themselves, and they will then go through the rather laborious process of evaluating whether or not any single payment that the borrower has made qualifies for public service loan forgiveness, using all of the criteria that we've been discussing. After that review process is concluded, Fed Loan Servicing will send the borrower another letter saying, here's how many qualifying payments you have made during the documented period of qualifying employment. And Fed Loan Servicing will not update that number unless or until the borrower submits another employment certification form or applies for public service loan forgiveness. What Fed Loan Servicing will do is tell the borrower, based on the assumption that we know everything about your qualifying employment, here's the earliest date that you could qualify for public service loan forgiveness if you continue to do everything right. But again, the number of qualifying payments that a borrower makes will only ever be updated if the borrower submits another form to us. We also have a PSLF application. And toggling back and forth between the employment certification slide and the application slide, you can tell that those two things are very similar. Also, this mouse is very sensitive. Sorry. The only difference between the employment certification process and the application process is that the Department of Education, Federal Student Aid, someone in our office, will actually review, look over the shoulder of Fed Loan Servicing to be sure that they have determined accurately that the borrower actually qualifies for PSLF. And when that is the case, and it's basically always the case, Fed Loan Servicing will actually write off the loan and send the borrower a letter saying, congratulations, you are in the 1%. Common issues. These are common issues related only to some of the paperwork that borrowers have to fill out. Honestly, when it comes to paperwork, it's borrowers not filling out the form right. We've done our best to make the form simple, but you all know borrowers don't fill out their FAFSA right. They're not necessarily going to fill out any PSLF paperwork right either. The biggest issues we see with their paperwork is not providing enough information about their employer. Their employer, we sort of uniquely identify using their employer identification number, the thing that you get on your W-2 at the end of every year, and leaving critical information about their employment dates blank. Obviously, we need to know when you worked, where you're saying that you worked in order to receive public service loan forgiveness and in order for us to determine what payments were made during your period of actual employment. And so leaving that information blank is going to cause your employment certification form to be rejected, or your application if you're applying. Of course, I've already said this, but it bears repeating. We only update the count of qualifying payments after we've made the initial determination if you submit another form. And so if you submit a form 5 years ago and we told you that you had 5 years of qualifying payments, we're not updating that number every month. You have to submit another employment certification form. Our talking point is to submit the employment certification form early and often. We recommend every year. But the employment certification form process is not required. It's optional. Borrowers don't have to use it. They can wait for 10 years and just submit an application and see if they qualify. There are some common program misconceptions as well. And if you were paying attention during the first half of the presentation, you will not be subject to any of these misconceptions. But borrowers frequently misunderstand the criteria for public service loan forgiveness. And so we're going to talk about some of the misconceptions that we've heard. But again, this is going to very much repeat information that you already heard. Eligible types of federal student loans. You all know what direct loans are. Those are the only loans that qualify. Consolidation can convert non-qualifying loans into qualifying loans, but borrowers, not unreasonably, often assume that PSLF is a federal program. So if I have a federal loan, then I can get this federal benefit. That is not the case. Only direct loans qualify. Employer eligibility. Borrowers, we get a number of questions about asking whether or not their job title is qualifying for PSLF, and we have to tell them, and everyone, often, that PSLF is not about what you do, it is about where you work. Financial aid administrators, teachers, janitors, if you work for a qualifying employer, your employment qualifies. Qualifying repayment plans. Again, the 10-year standard plan qualifies, but you should never tell anyone that. It's for PSLF, only income-driven repayment plans. You can't get PSLF unless you get into an income-driven repayment plan. Consolidation, like we've talked about, can help borrowers qualify for PSLF if they did not have the right type of loan. but only payments made on the new consolidation loan can qualify. Again, remember my example of someone who had a FFEL loan and made 10 years of payments, finally learned that they needed a direct loan, and finally consolidated. The 10 years of payments that they already made on that loan do not count. That is one of the only things that you can do that resets your clock towards PSLF is consolidating. And then the appropriate time to start tracking towards PSLF is not after you think you've made 10 years of payments. It is now. It is early. It is often. Again, every year is what we recommend, but early and often is what we recommend. Let's talk about some data, because we know you all love data. We implemented the employment certification process in January of 2012. And what you can see on this slide is that over time, we have seen a lot of borrowers finally start to submit employment certification forms. Up until recently, and recently for the government is the last several years, most borrowers were only submitting their first employment certification form. What you can see on this slide through the red part of this chart, which is borrowers who are submitting second, third, fourth, fifth employment certification forms, has finally overtaken those who are trying to certify for the first time. So we are finally starting to see borrowers actually submit a form maybe every year, but at least more than once, which is definitely better than one form and then nothing. As of August 2019, we have about 1.2 million borrowers who have certified for PSLF. These are borrowers who have at least one direct loan and work for a qualifying employer. This is not how many borrowers have made any qualifying payments, though. You remember when I talked about how there are 3 different categories of qualifying employer, generally speaking, but only 2 really qualify? You see that borne out on this slide. 62% of borrowers who have certified for PSLF work for some type of government organization, and again, that's federal, state, local, tribal government. And 38% approximately work for 501c3 not-for-profit organizations. There are organizations in these other buckets that do qualify, but so few of them have been returned to us that the numbers actually round down to 0. That's why you should only ever really talk about government organizations and 501c3s. There are others that qualify, but it's very rare. Qualifying payments. What you see on this slide is sort of 2-year tranches of where borrowers are in terms of qualifying payments. You can see that our largest bucket is borrowers who have made 0 qualifying payments. That's not great, but the point of opting into this tracking process is so that you find that out. And so when you make 0 qualifying payments, it frequently generates a call to Fed Loan Servicing, who will explain to the borrower why there's 0. And it's generally going to be something like, you are not on an income-driven repayment plan, or you've spent a lot of time in deferment or forbearance. We've seen these numbers move progressively over time upwards so that you actually do have borrowers who are in higher levels of these sort of tranches of qualifying payments. But bear in mind that all of the data that we're presenting about PSLF is based on a borrower's most recent employment certification form or their application. And so our data is only as reflective of what is actually happening in reality as borrowers are submitting their employment certification forms early and often. And as we saw a few slides ago, for the first basically 10 years of this program, borrowers were not submitting more than one form. And so these data are not necessarily reflective of where borrowers actually are. They're reflective of a specific point in time. Some other interesting facts. Of borrowers who have a direct loan and have submitted at least one approved employment certification form, and as of September of this year, 53% of borrowers have only submitted one employment certification form. That doesn't sound great, and it's not, in my opinion. This number should be far lower. However, we are starting to see it trend downwards. In January of 2017, when we first started analyzing these data, that number was 68%. So the numbers are trending downward, and you saw that borne out on one of the prior slides, where borrowers are finally starting to submit more than one employment certification form, which personally makes me happy. About 12% are actively repaying their direct loans under a non-qualifying repayment plan. So that's going to be extended, graduated. Those are basically the only two. Those people are told naturally that they need to get into an income-driven repayment plan in order to qualify for PSLF, but that is their choice. What we frequently find out about borrowers who are in this 12% is that they do not want to get into an income-driven repayment plan because it would actually make their payment go up, and they do not want to pay more. The economics of public service loan forgiveness are only going to make sense for you or any given borrower if the economics of income-driven repayment inherently already made sense. So if income-driven repayment is something that you are naturally going to be attracted towards because you needed to make a lower payment based on your income, then PSLF is for you. If you're comfortable repaying your loans under the extended or graduated repayment plan, then PSLF just may not be for you. But these 12% of borrowers are the borrowers who have indicated an interest in PSLF and are generally those who we find are not ultimately going to receive it and know that they won't, but that's because they certified. 4% of borrowers are in an income-driven repayment plan are in a deferment or forbearance because they have faced some type of financial hardship. These are the borrowers where income-driven repayment is not working as well as it could, or they do not know that they can, when they run into financial problems, call us and immediately have their payment recalculated to reflect their actual current financial situation. This is a population of borrowers that are very much ripe for outreach from us, and in fact, we do outreach to these borrowers through Fed loan servicing. Whenever a borrower seeking PSLF goes into a deferment or forbearance, they are told, these are entitlements, you are welcome to use them, but these periods don't qualify towards PSLF, and you can recertify for income-driven repayment. But again, one of the benefits of submitting an employment certification form and opting into our tracking is that you get what I call PSLF-sensitive servicing. Once you opt into this process, you are told by Fed loan servicing whether any given action that you are going to take with respect to your loans is going to help or hurt with respect to public service loan forgiveness. But you only get that if you submit the employment certification form. And that's one of the reasons why that form is so powerful. So we can talk a lot about this during the Q&A, and I imagine you all have a lot of questions about this, but you've all heard NPR, New York Times, Washington Post stories that say that only 1% of borrowers who have applied have received public service loan forgiveness. The reason why that is true is generally because borrowers aren't qualifying. There are a lot of criteria. A lot of borrowers who want PSLF have never submitted an employment certification form. When I received the data point that I'm about to describe, I was so shocked by it that I asked them to run it again. 80% of borrowers who have been rejected for public service loan forgiveness have not even been in repayment on their direct loans for 10 years. And while granted, I am perfectly willing to admit that the program is complicated because borrowers don't know what direct loans are, they don't know what plans qualify, and they may not know what employers qualify, what I generally expected borrowers to understand is that PSLF requires 10 years of payments and service. But there's no penalty for applying for PSLF, right? This is a program that you can apply for as many times as you want, and we will reject you as many times as you don't qualify. I'm sure you've dealt with some of these students at your schools. But again, it's 80% of borrowers have not been in repayment on their direct loans for 10 years. And we are using a very generous definition of 10 years of repayment. We're talking about their grace period ended 10 years ago. We're not looking at whether or not they were in deferment or forbearance. We're not looking at what repayment plan they were on during that 10-year period. They had not even exited their grace period more than 10 years ago. That's staggering. And it provides a lot of context for why only 1% of applicants have been approved. We have another 15% of borrowers who were rejected for PSLF who don't have any direct loans. These are borrowers who have probably FFEL program loans. and did not understand that they needed to consolidate in order to receive PSLF. Again, this is another staggering statistic, but it's one that I actually understand. You all know that borrowers don't know the difference between a FFEL program loan and a direct loan. Borrowers don't. And this is a population of borrowers, the 15%, who almost certainly never submitted a single employment certification form, sat out making payments for probably 10 years, and applied for PSLF only to get a rejection letter. So we know that no one's basically qualified for PSLF, and there are a lot of reasons why that's true. And because of this, Congress created what we call the Temporary Expanded PSLF program. To get PSLF, Temporary Expanded PSLF, you need to have qualified for PSLF except that you were in the wrong repayment plan for some period of time. But this is a program that is temporary, you can hear that in the name, and is subject to appropriations. That's not something that we're used to in the federal student aid space. Normally, all of our programs are entitlements. Congress doesn't need to actually appropriate money, for example, for us to issue direct loans, but Temporary Expanded PSLF is subject to appropriations. There are two numbers on this slide, 700 million and 1 billion. We don't need to worry about either of these numbers for a long time because only 1% of applicants have been approved for TEPSLF as well as PSLF. It's going to take a long time for this program to subset, so while it is temporary, it's only temporary in the legal sense. It's going to take a long time for the funding to run out. But when that funding does run out, this program will sunset. So to get TEPSLF, the borrower needs to not qualify for PSLF only because some or all of their payments were not made under a qualifying repayment plan. So the graduated plan, the extended repayment plan, the consolidation standard repayment plan, and the consolidation graduated repayment plan. Those are the repayment plans that I'm talking about. There also need to be funds available to expend under the program. We need to have not hit our aggregate forgiveness caps. Again, these two bullets are not going to matter for a very long time. And then there's this last criterion that is really hard to actually say out loud, so I'm literally going to read my slide to you because it's the only way that I can keep it straight in my head. The following payments need to at least have been as much as the borrower would have paid under an income-driven repayment plan. There are two payments that we have to evaluate to see if they meet this criterion. The payment that they made 12 months prior to applying for TEPSLF and the last payment that they made before applying for TEPSLF. And so one quick example of how this works is, say the borrower is in the extended repayment plan, their payment is $200 a month. They apply for TEPSLF. We then need to ask them for income documentation and their family size to figure out what they would have been required to pay when they made both of those payments under an income-driven repayment plan. We will then perform that calculation. Let's say that the revised pay-as-you-earn payment that the borrower would have had to pay based on all of the documentation that they submitted to us was $150. That borrower meets this criterion because their payment would have been lower under an income-driven repayment plan than what they were actually paying under extended. There is one small exception for borrowers who have had, quote unquote, an unusual fluctuation of income over the prior 5 years. We have no definition of what an unusual fluctuation is. We work it out on a case-by-case basis. As far as I'm aware, no borrower has tried to qualify for TEPSLF on the basis of having an unusual fluctuation of income, but it is technically an option. The application process for TEPSLF, you need to first have been determined that you don't qualify for public service loan forgiveness. You can then, after you've received your rejection letter for public service loan forgiveness, email Fed Loan Servicing and say, I want temporary expanded public service loan forgiveness. And then Fed Loan Servicing will go through the process of determining why you were denied for PSLF, whether or not it's the right reason relative to TEPSLF, and then perform the income-driven repayment calculation. We don't really need to talk about this because we've already talked about it really, but basically no one is qualified for TEPSLF either. And the reason, again, is that a lot of borrowers haven't even been in repayment on their loans for 10 years, using that same very liberal definition of what constitutes 10 years of repayment. We also see 20% of borrowers who would have had a higher repayment under income-driven repayment than what they were actually required to pay. And if you think about it, and when we were talking about the economics of public service loan forgiveness and it only making sense of income-driven repayment would have otherwise made sense for you, this is that population of borrowers, where income-driven repayment was not a good sort of economic deal for them. And they're also not going to qualify for TEPSLF. And again, another 15% of borrowers didn't have direct loans and did not know that they needed to consolidate. Resources before I open it up to questions. We launched the Public Service Loan Forgiveness Help Tool in 2018. That help tool basically helps you fill out either an employment certification form or an application. We walk you through all of the various questions that you would need to answer in order to have a form generated for you. So you can see here that first we help people understand if their employment qualifies. Next, we tell them whether or not some or all of their loans qualify, or if they're in the right repayment plan or the wrong repayment plan. We allow you to add multiple employers to this tool so that if you are finally, getting into PSLF, maybe 5 years in, you can add all of the employers that you've worked at over the course of that, for example, 5-year period. And then we help you figure out whether or not it's theoretically even possible for you to have a PSLF application that's going to be forgiven. And again, we're using, for now, that very liberal definition of have you been in repayment for at least 10 years. If you have, then we'll let you, we'll default you to a PSLF application. If you haven't been in repayment for 10 years, we're going to default you to submitting an employment certification form instead of an application. These are defaults. Borrowers can say, no, I think you're wrong. I think I qualify for PSLF now, and submit an application instead of an employer certification form. These are just defaults. But ultimately, at the end of this process, for now at least, all the help tool does is generate a PDF that a borrower needs to then take to their employer, have them sign it, and either fax it, mail it, or if they happen to already be with Fed Loan Servicing, upload it to Fed Loan Servicing's website. The help tool is basically what I think of as a down payment on a much broader suite of functionality that we are hoping to implement over the course of the next year. We're targeting a lot of enhancements for the summer of next year with respect to this process, where we will allow borrowers to digitally sign and submit, and have employers digitally sign and submit their employment certification forms or their applications. We're hopefully going to build out a database of qualifying employers so that if you log into this tool and you type in an employer identification number, we can tell you basically you are pre-approved for public service loan forgiveness based on your employment. And providing more contextual data to borrowers who are coming back and filling out another employment certification form about where they may actually be in the process of making 120 qualifying payments. All of this is being enabled through our Next Gen FSA initiative. So all of these improvements are not only going to provide a broader suite of functionality, but they are part of this entire integration that we are working towards with Next Gen FSA. And so stay tuned, basically, for a lot of improvements, not just to public service loan forgiveness, but absolutely every process that a student interacts with through us. There are a bunch of links to our website where you can get more information about public service loan forgiveness, temporary expanded public service loan forgiveness, and the PSLF help tool. And with that, I'm now happy to open it up for questions.
Hi, my name is Mark Kantrowitz. I was involved in the original design of income-based repayment and public service loan forgiveness, and I warned people at the time that it was too complicated. And I appreciate that borrowers overestimate their eligibility. In fact, I predicted before we had the first borrowers qualifying that there'd be about 100 borrowers qualifying, and the actual number was 96. But I still, based on my recent experience with borrowers who have been rejected by Fed loan servicing with relatively low numbers of qualifying payments, where they've given me their entire payment history, their entire employment history, and I found that these borrowers were credibly, inaccurately being denied. I just have trouble believing that 80% figure, especially, I shouldn't have borrowers representing 5% of those the ones who should qualify as rejects, and so it strikes me, especially with that GAO report that suggested at a very high error rate that maybe the servicer is still having lots of problems counting the number of qualifying payments. So, and that's just a general concern that maybe you need to do more auditing of those who are rejected to confirm that 80% figure. And after all, the June 2019 data that you put out shows 55% of borrowers being rejected because of qualifying payments, which I assume includes the number of qualifying payments. So how does that reconcile with 80% not having made payments for 10 years? So I don't believe it. And there's a lot that suggests that maybe those numbers aren't actually right. So maybe there needs to be more careful review. Question that I have that is that if a borrower is rejected for temporary expanded PSLF, the TEPSLF, is a strategy that they could take is to switch into, say, standard 10-year repayment for the last year and then apply again, or into an income-based repayment plan for the last year and then apply again, because then they would satisfy the criteria of the last payment and the year prior payments being at least as much as they would have been under an income-driven repayment plan.
That's not actually accurate. If a borrower switched into the 10-year standard repayment plan, it's not a foregone conclusion that their payment would be at least as much as they would have been required to pay under an income-driven repayment plan. What I will say is that if a borrower gets rejected for TEPSLF because they did not meet that criterion at first, they can switch into an income-driven repayment plan, make payments for a year, reapply, and receive TEPSLF. Okay,
because that's the advice that I've been giving to borrowers who are rejected. One thing about your help tool is that it doesn't have a fail first ordering of the questions that it asks. In other words, if 80% are being rejected because they haven't made 120, haven't been in repayment for that long, then you should have that as your first question, not your last, so that you can immediately tell them, especially if they're logged into with their studentloans.gov, so that you access the actual data on how long they've been in repayment. And you don't even have to have them answer the question. You simply say, based on how long you've been in repayment, you're not yet eligible. Now, if it's because they consolidated from FELP.
I don't want to interrupt you, but there's a really long line of people who want to ask questions. I will say that we do, in fact, do exactly what you are suggesting, and we don't, in fact, need to ask anybody whether or not they've been in repayment for 10 years, because we, in fact, know that. We use that data to drive what form that borrowers submit, and we don't want to foreclose the opportunity that a borrower can use the PSLF help tool in order to engage with us on the employment certification process and not the application process. So I understand what you're saying. There is a lot more that we can do with respect to data integrations in the PSLF help tool, and we are in fact going to do them. But I appreciate your comments. Thank you.
Okay. And the final one would have been to require it as a worksheet before they could apply.
Thank you.
So I qualified for PSLF last year, so I'm part of the
You're the 1%.
Yeah.
Congratulations.
It was difficult. So I was a 10-year standard repayment, auto debit. It was my 9th year that I decided to do it. It wasn't very clear because I wish the two PDFs of the actual employment verification and the PSLF application were up. They look exactly the same, and I noted that you said there's a slight difference. I didn't see any difference on those two applications. So when I submitted it, there wasn't really any clear follow-up, and I'd often get emails from several different people about the employment verification, would send another. So in total, I think I sent it like 6 times. I did end up overpaying and getting paid back because I did miscalculate my payments. So I graduated in 2007, started making my payments October 2007. So 2017 had passed and I started getting into 2018. And I think just because I worked in financial aid, I was savvy enough to do all the follow-up, but it is pretty confusing, I would say, still for a person who, qualified for very little forgiveness, but still something.
Yeah, so first of all, I apologize for your experience. It's absolutely not what we want. It's not what we strive for. And I agree with you. You're a financial aid administrator. You are perhaps the only people who are going to be the ones who qualify for PSLF at first, because you are the only ones who understood what a direct loan was, for example.
I hope not.
Right? And so if you had that experience, we know that borrowers are having a much worse experience. And that's not what we want. We take our oversight and stewardship obligations for this program very seriously. And all I can do is promise you that we are trying very hard to improve the level of service that people are receiving. And so much of that is being enabled through our Next Gen FSA initiative. And I really hope that through this conference, all of you take away that Next Gen is a real thing and that it is happening and is going to provide a lot of additional benefits to people. And so again, I very much apologize that you had that experience, and we know that this happens and we do not like it.
Thank you.
Yeah.
Hi. I just wanted to say I work mostly with graduate students, and so we talk a lot about public service loan forgiveness with those students, even on the very front end at orientation or open houses. And a lot of what we hear is, well, only 1% was approved. And then I have to provide some context to the 99% that were not approved. And I'm wondering if we could maybe change the headline a little bit in the way that we talk about the data, and instead of saying 1% were approved and 99% were rejected, we could say 1% were approved, 5% were outright rejected, because let's say they applied with private loans, and 96% or something do not yet qualify. And that incorporates your 80% who haven't made those 10 years worth of payments. Yes, they were rejected, but they can still keep applying once they know the rules. And I think it would be a better headline than the 1 versus the 99.
I 100% agree with you. We have a free press in the United States, so I'm not really empowered to change the headline. But if you want to talk to the press about that, then you should feel free. We're trying to be better about that.
I also work at a graduate school where the loan debt is really high, and we talk a lot about just the income contingent plans for 25 years. Students don't want to pay for 25 years and then have it taxed. They get really scared about that. One of the things they talked about, I was interested in your listing of 501c3 employers. My students will say, well, I'm just going to set myself up or set up my clinic or whatever as a 501c3, and then it'll qualify for the public service. And I keep telling them it's not that simple to do that. Do you have any information of those 501c3s? How many are self-employed or have their own clinic or something like that where they are the employer? Yeah,
so you're right. It's theoretically possible to set up your own corporation and get it as status as a 501c3 and qualify that way. We don't have good data tracking about how many of these people are being very strategic about setting up a 501c3 in order to qualify for PSLF. When we do see that, for example, the person certifying the employment and the borrower are the same person, we do some follow-up because that inherently raises some red flags, right? But generally speaking, that's not something that we have great insight into. It's something that Fed Loan Servicing does, and they don't report to us necessarily like on an ongoing basis. So I don't know how much it's happening, but you're right that it's not really the easiest thing in the world to do. If you're going to do this, and you have to be quite committed to the outcome. But we know that it happens, and for those who are willing to deal with state law setting up a corporation, getting tax exempt by the IRS and the Department of Education for PSLF, more power to you.
Hello. Admittedly, I'm here for selfish reasons as I'm trying to get loan forgiveness for myself.
Hey, me too.
So-
Go ahead.
So I have a couple of questions in reference to the mechanics of things. You mentioned that we should submit the employer certification form annually. My question is, do we have to resubmit for every employer every year? So for instance, over the last 7 years, I've worked at a 501c3, I worked at 2 state organizations, and so do I have to continually send the same forms for the same organizations each time, or is it just an update once I've sent it the first time?
So I'll go out of my way to say that we do a lot of crazy things at the Department of Education. The first thing that you suggested is not actually something that we would do. It's really the second thing, where once you've submitted sort of like your back employment history, when you submit updates every year, which again, I very much encourage you to do, it's only the new period of employment that we need to have information about. We absolutely retain the other periods of employment that you've previously submitted to us, and you don't need to resubmit those.
Okay, then I have one last quick question. What is the communication that I'm supposed to receive? Because I have submitted this before and I've never heard anything about whether my payments qualified, whether they didn't. I got no communication whatsoever, so I'm not sure what I should be expected to receive.
So that's a problem. This is, I mean, to be serious for a moment, PSLF is right now a very highly manual process. Anytime you have a very manual process, and you all know this because you work at schools and you probably have very manual processes for some things, they are error prone. Things will fall through the cracks. When we find out that something has fallen through the cracks, we will use it to do a root cause analysis and determine whether there's a global problem that we need to fix, or whether or not we just need to fix you. So if you would come up to me after the session and give me your personal details, I will personally ensure that we sort you out.
Thank you.
You're welcome.
Hello. First off, I really enjoyed your presentation, so thank you for putting the time into that.
Thanks.
Also, partially selfish reasons, I am in the process of public service loan forgiveness. I have about 2 years left, so the light at the end of the tunnel is nearby. Some feedback. The first is with the employment certification form, I've worked both, I'm local, I've worked at University of Nevada, Reno, and I've also worked at University of Nevada, Las Vegas. Very similar names. And the employment certification form, they use that name over the EIN number. Both of these universities use the same EIN number, and it has been the biggest hiccup for me every single year. They've wanted to speak to the director of human resources at my institutions to clarify, because they're like, you can't work at 2 places with the same start dates. And then if you put University of Nevada, comma, Reno, University of Nevada, hyphen, Reno, University of Nevada, Reno, they list them as separate employers every time, every year, and they get confused. And if they just use the EIN number, it would get rid of that problem. But they're not doing that. And it's not only a headache for me, but it's a headache for my university and my HR director who has to talk to them.
Yeah, thanks for calling me out on that. We know.
Sorry.
What I would advise you to do is just write University of Nevada with the same EIN every year and not do hyphen Reno or hyphen Las Vegas.
And we can do that now, which is great, but the old form, they wanted all the school information to be filled out by HR. So it
Yep.
wasn't me filling that out, it was whoever got the form in HR, and so it was whatever they put on it.
If you would like me to send an email to your HR office, I will do so. It's sort of a side job that I do, helping employers figure out how to actually fill these forms out for their borrowers. So if you want to email me, like, we can connect with your HR office and get it sorted out.
Okay.
In terms of calling me out on this thing that's bad, we are actually going to fix it.
Okay.
We're aware, and it's one of the things that we're hoping to enable through our Next Gen initiative.
Okay, thanks. And one other question is at the end, because the pending applications is so high, what should borrowers who are in the process of applying, who believe they have met all of the criteria, how long are they in pending for? And what is a reasonable timeline that they should be in pending, and when they should start being like, okay, this has been way too long, and start being a squeaky wheel and calling Fed loan?
Yeah, so I would say that we struggle to provide standardized timelines because it's so highly variable based on whether or not you've certified your employment previously. As you know, and I mentioned, the employment certification process is optional, highly recommended, but optional. And so if we've literally never heard from you before about public service loan forgiveness and you're submitting 10 years worth of employment, the timeline associated with you is going to be so much longer than it is for someone like actually you who has been certifying employment. I would say the only timeline that I'm personally comfortable providing is the timeline that I would expect to apply to someone who has certified before. And I would say if it's taken longer than 3 or 4 months to get a decision either way, then that's when you should start being a squeaky wheel.
Okay, thank you very much.
You're welcome.
Good afternoon. I had a question in regards to the qualifying payments. You mentioned that if you are not required to make a payment and you make a payment, those are not considered. So my question is for students that are returning back in college and they get the in-school deferment and they were already qualified for an income-driven repayment plan, and the school sends the enrollment to NSLDS and it gets updated as in-school deferment. And for somebody like me, I've been in school, I graduate, I go back, but I've been working full-time. Do you still qualify those payments, or do you have to contact the servicer to request to take me out of the in-school deferment?
Yeah, you're right. When you all know, when you report enrollment to NSLDS, that's sent to our contractors. The contractors put the borrower back into an in-school deferment automatically. For most people, that's great. But if you're trying to qualify for PSLF, if you're in an in-school deferment, you cannot make qualifying payments. And the only way that you have to make qualifying payments after we put you back into an in-school deferment is to call your loan servicer and request to be opted out of in-school deferment. What I will say, and again, a lot of the power of certifying for PSLF and moving to Fed loan servicing is you do in fact get PSLF sensitive servicing. And so Fed loan, unlike some of our other servicers, actually allow you to do what I would call like a permanent opt-out of being automatically placed into an in-school deferment, because you all know you report enrollment to us pretty often.
Every 30 days.
Thank you for your data, by the way. So if you are at Fed loan servicing, you can basically tell them, I'm trying to get PSLF. Don't put me back into an in-school deferment based on my enrollment unless I call you back and tell you otherwise. But you do, in fact, need to make that request.
Okay, and my second part to that question is, I went to school in 2005, and so I was with Sally Mae. My question is in regards to the private loans versus the federal loans, and if I request the federal loans to be opted out as in-school deferment, but the private loans, your in-school deferment, how does that work, or is it one or the other?
So I know 0 things about private student loans because we are the Department of Education. We have nothing to do with them. That is between you and your lender. What they can do for your federal student loans, I can talk about. What they can do for your private student loans, I cannot talk about. And so what they may do in that case, I can't really say.
Okay.
Sorry.
Thank you.
Hello, I'm also here for selfish reasons. So you did answer one of my questions, which was how long does it take to, like after submitting the application, it sounds like 3 to 4 months. Do we then need to keep paying during that time?
Yeah, so again, I'm going to say it again. The 3 to 4 month time frame is only a reasonable time frame if you've previously certified your employment.
Okay. That's my other question, actually. I have never gotten a response after submitting that form, like ever. And so I just assume that it's going to where it needs to go, but I've never heard. And then just very recently, I found out that half of my loans don't qualify because I have never gotten a response from anybody. And then somebody finally told me that my loans didn't qualify because they were the wrong type of loans. So I don't know if it is an individual issue, but it definitely, I've heard some other people say that they've had the same issue with communication, and so it might be something to look into, because now my clock has started all over again, and I literally had a nervous breakdown that day.
So I will do what I'm getting very good at these days and apologizing for the experience that you've received. It's, again, not what we want. This may be an individual issue, it may be a global issue. You are another person who should come up to me after we are done. Provide me your personal information, and I will ensure that we fix whatever the problem is. What I will say is that when we make an error with respect to things like preventing you from making a qualifying and payment based on information that we've provided to you that may have been inaccurate, we have processes in place to hold you harmless for those types of errors. So don't have a nervous breakdown. We may be able
It was the wrong type of loan. It wasn't a direct loan, so I was told there was nothing that I could do.
Yeah, no, but I mean, even if it was a federal family education loan program, loan type, if you were told by someone who works for the Department of Education that you were doing things right, and then that turns out to be false,
nobody ever from the Department of Ed contacted me.
Okay, that is also a problem. So
Right,
again,
yeah.
let's
That's
talk.
the communication piece that I've been missing.
Yeah.
Yeah.
That's also something we will evaluate when we figure out whether or not we made an error. So
Okay.
absolutely come up to me after, and we'll sort you out.
Okay, thank you.
Yeah.
Hello? So I just had a great idea while I was standing here in line that I think all financial aid administrators should automatically get put into this program. I think we deserve it. But anyways, so I just, back to the temporary plan. You may have answered this already, but I just want to clarify it. So you, when you apply, you have to have at least one payment that the value of the payment is with an income-based repayment plan, right? And then you have to have 12 payments after that to be in part of the program. So for me, I was in a graduate plan for the past 10 years that I've actually been a financial aid administrator. So is it that all those 10 years of payments will then get put toward my 120 payments?
Yeah, this is a really good question, and I did not say this very clearly, in part because it's impossible to say clearly, but in part because I just didn't say something that I should have said. So thank you for asking this question. First of all, with respect to automatically opting you all in, if your HR offices want to set up a data exchange with us where they provide all of your employment records, I'm happy to have that conversation. It sounds like something that schools probably wouldn't be interested in doing, but if I'm wrong and your school does, we should talk. Secondly, about your actual question, you're right that we're looking at the payment made 12 months prior to applying and the payment last made before applying. And if those two payments are at least as much as you would have paid under an income-driven repayment plan, then you satisfy that criterion. But it's not just those 12 months of payments that qualify. Once you clear this hurdle, we evaluate all of your payments, and all of those payments that you made under the graduated repayment plan can be counted towards temporary expanded PSLF.
Even if they're not?
Even if those payments were not as much as would have been made under an income-driven repayment plan.
They could still be counted toward?
Yes, if you satisfy that 12-month seemingly arbitrary criteria, then all of your payments can be evaluated regardless of how much they were.
Cool. Just one more quick thing.
Yeah.
If I didn't come here this morning, I wouldn't have known that.
I can understand why that is true.
Yeah, so, thank you.
You're welcome.
Hi, Ryan Liebenthal. I have a question about that misinformation piece you mentioned a couple of questions back. So for the 15% of people rejected because they don't have the right loan, I've heard from a lot of borrowers who were told by their servicer, not Fed Loan, but a different servicer, that they were all on track, and they only find out later that they're not, and they didn't know about they didn't go look up the information separately to find out about the ECF and everything. So to what degree is there that service or responsibility? And, you know, what is the process for redress for those
Yeah,
borrowers?
so I would say that the service or responsibility is to provide accurate information. So if one of our contractors tells a borrower with a FFEL loan that they are on track, that would be inaccurate information. And that would be a basis for us to go back, and after a borrower consolidates and gets a direct loan, go back and give them credit for payments that they made while they had FFEL program loans on their new direct loan. What I will say is that, first of all, this treatment only applies to information that is given out by a contractor for the Department of Education. So if this is, for example, a FFEL borrower who has a commercially held FFEL loan, this is not something that we do, because it's not an error that we, the Department of Education, made, albeit through a contractor. In order to avail yourself of this type of, I wouldn't call it benefit, but remedy, is to file a complaint through the FSA feedback system. And if you can access that on studentaid.gov. But that is the quickest, easiest, clearest way that we will evaluate whether or not we did something wrong and need to hold the borrower harmless as a result.
And then once that complaint is being evaluated, do their payments have to still equal the amount that they would have, or do they get credited sort of regardless?
No. When we make an error, it doesn't matter.
Okay. Okay, thanks.
Yeah. And also, I'm sorry, I realized I did not answer a question that someone had a few questions ago about what happens after you apply and whether or not you need to continue to make qualifying payments or make payments during that time period. The answer is no. We actually automatically opt you into a forbearance while we're processing your application. If you're not super sure that you qualify for PSLF, and I can understand why you might not be sure if you qualify for PSLF, you're free to opt out of that forbearance. The PSLF help tool actually recommends that you continue making payments while we're processing your application because we know so few borrowers qualify. Know too that if, as a result, you've quote unquote overpaid your loans, you will get a refund from us of payments that you made in excess of 120 qualifying payments. So, sorry, and next question.
Yeah, I just wanted to ask a little more about the 80% number and
Sure.
whether you can specifically dive into whether you know how many of those borrowers are older consolidation loans.
Yeah, so it's not on the slide, and the statistic is very much about borrowers who have direct loans. And so what I will say is that while you may logically think that like the 80% number is because of consolidation, we also ran the statistic differently to see how many of them, basically to include when they entered repayment on loans that they subsequently consolidated. And I don't remember offhand exactly what that statistic is, but it was between 70 and 75% of borrowers, after we factored in loans that they subsequently consolidated, still hadn't been in repayment for 10 years. So it's still a pretty high number of borrowers. Yep.
Oh, this is low. When a borrower gets married, can they have their repayment plan recalculated to reflect the household size prior to the anniversary date of the payment plan, or they have to wait till recertification?
Borrowers can recertify early for whatever reason at any time.
In that case, it would just look at the individual return for the borrower?
When you recertify early, you have to fill out a completely new income-driven repayment application, and so it's not a simple matter of just calling your servicer and saying like, hey, my family size has increased, recalculate my payment. And so because borrowers are filling out a new income-driven repayment application, all of the factual questions we ask you about, are you married, how do you file your taxes, who's in your household, apply. And so if the household increased because somebody got married, then we may also be factoring in the new spouse's income into the calculation of the borrower's income-driven repayment amount.
So is that also true if they are married and file separately?
This is why I very much wish that we also had a session on income-driven repayment, because this is very much a question that's not actually about PSLF, but because PSLF and income-driven repayment are so integrated, you can't really not talk about one without talking about the other. For income-driven repayment, how you file your taxes controls whether or not your spouse's income is included in your payment amount for the income-based, income-contingent, and pay-as-you-earn repayment plan. For the revised pay-as-you-earn plan, it does not matter how you file, and with very limited exception, even if you file separately for the revised pay-as-you-earn plan, your spouse's income will be included in the calculation of your payment amount.
Thank you.
You're welcome.
Hello.
And I will say that this is also probably the last question I'll be able to take, but I can hang around for a little while outside and answer more.
Well, thank you for me being the last one, at least. I work in a public health school where almost all of our graduates will go into government or a 501c3, and they all have direct loans. So I'm optimistic that we're going to push that 1% number up. But what my question is about the counseling, the taxation ramifications of. Because I've heard different things about what amount is not taxed. Can you go over that, please?
Yes, I absolutely can, and it's hard, and no one can ever keep it straight in their heads, and I very much understand why. Income-driven repayment on its own provides loan forgiveness after 20 or 25 years of payments. The entire amount that is forgiven is treated as ordinary income when you file your taxes, and you may have to pay tax on that amount. If you receive public service loan forgiveness, that amount is never taxed.
Never taxed?
Never taxed. Okay. PSLF is not taxed.
Okay, thank
you.
Yep.
Thanks, everyone.